Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending July 30th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is Do Bonds Have It Right? Does the bond market have it right? Well, let's take a look at this past week. What a wild week we've had. It was been a very busy week as far as earnings goes. So let's just kind of talk through it and see how things kind of shaped up. Let's look at the index performance first. As you can see, everything was in the red, just barely. Nasdaq had the worst round of it, being down 1.11%. Year to date, S&P is leading the way at 1709. Russell is bringing up the rear. Now, it was leading most of the year until about a month ago. And if we look at the forward valuations PE ratio, um, it's 22.52, so it's still elevated. The dividend yield in the S&P 1.31, 10-year treasuries at 1.239. So the spread between the 10-year and the dividend yield in the S&P is 7.1 basis points. So that means that the dividend yield is that much larger than the 10-year treasury. That continues to push money into the equity markets, everybody. If we look at the sector performance, you can see that the best sector this past week was materials. XLB at 2.8%. Worse was discretionary. That came in at minus 1.55. Best sector for the year, energy still leading the way, 33.05. It was up over 50% earlier this year. Utilities bringing up the rear, but still in the green at 6.82%. Now, indexes, as I said, from an earnings standpoint, is very active. It's the busiest week of the year with about 177 S&P 500 companies reported. Especially busy for big cap tech. We had, besides Tesla leading off on Monday, we had Apple, Microsoft, and Google on Tuesday, Facebook on Wednesday, and Amazon on Thursday, all releasing their earnings. And then a big decline in Amazon Thursday kind of weighed heavy on the consumer discretionary sector following their news Thursday evening after markets closed. Their consensus second quarter revenue missed expectations and they guided a little bit lower for the year. So that tended to hurt some of the big cap tech. Now, if you guys remember in Q1, we had the same thing. The earnings were essentially strong, but the market sold off on earnings. So at these nosebleed PE levels, companies have to have the sun and the moon and the stars all line up to do very, very well. Okay. So if we look at it, and let's just take a look at some of the economic data that hit last week as well. Commerce Department reported GDP for the U.S. It increased at an annualized rate of 6.5% in Q2, and although that's high, it was shy of the consensus estimate of 8.5%. Nevertheless, still came in at the second fastest pace of growth since 2003. All right, and it left the current economy larger than the pre-pandemic peak. Okay, many analysts had talked about lingering supply chain problems. I mean, we've got huge stoppages in the supply chain as part of the reason for the lack of stronger showing in the GDP. And we also got durable goods. They came in well short of expectations, as did core capital good orders and shipments. So we got that. We also had weekly jobless claims that fell less than expected. Continuing claims rose just a little bit. So these were some of the downside news in the economic data this week. We did have the July consumer confidence is surprised to the upside, but that tends to be a very lagging indicator. Inflation expectations eased just a little bit. Personal spending rose more than expected in June, as it should. Income levels are up, even though a lot of people were laid off or not working because they're making more money from the US Gov. So, in a crazy Machiavellian sort of way, a lot of people are just not working because they're making more money from the government. The Labor Department also measured their unemployment costs. It rose 70 basis points in Q2. Now, in Q1, it rose 90 basis points, but labor costs tend to be very sticky. That would be the non-transitory part of inflation. All right. So we are seeing something like that happen. Now, also, if we look at treasuries, um, this reflecting some of this downward growth and inflation surprises. The yield on the 10-year actually came in lower. As you can see, for the week, it finished at 1.39%. So that's a very low 10-year yield. I mean, it's kind of, I had said earlier, did the bond market have it right? And it appears it does so far. It's been falling for about 45 days or so, 60 days almost. The bond interest rates have been coming back. And typically, when you see interest rates coming down rather than up, it's not a vote of confidence on a go forward basis for economic growth, nor is it showing any fear of potential inflation. And thus far, the bond market seems to have it right. Okay. And believing that the Feds, as the Feds have said, that a lot of the inflation is transitory. And speaking of the Feds, we had them come out this week. Now, their statement on the 28th was a little bit hawkish, more hawkish than the markets expected. But even that, our Fed chair, the U.S. Fed chair, Jerome Power Ranger Boom Boom Powell, came out and he kind of underscored that the committee's marker of substantial further progress has not been met yet. And remember that substantial further progress is when they're talking about cutting stimulus to the tune of 120 billion a month is what they're spending, 80 billion in treasuries and 40 billion in mortgage-backed securities. That's where I think they're going to start cutting first. And we've got coming up in the month of August, which historically has not been a very good month for U.S. markets. We got the Grand Poopah Muckety Muck meeting in Jackson Hole, Wyoming, with all the central banks, Bank of Japan, Bank of England, U.S. Feds, Bank of Canada, Bank of England, ECB, all these guys meeting in Jackson Hole. And they tend to get together and collude in their globalist fashion. And then they talk about what they're going to do with rates. So Europe is already on record as talking about cutting stimulus, or at least discussing it. But the Fed's Boom Boom Powell is very accommodated right now. Let's see what he says this August. There is no FOMC meeting, which is replaced by this Jackson Hole, Wyoming. In many respects, can be bigger. Okay, so that's a little bit about what we got in U.S. Treasuries. The other thing is there is some optimism out there that the Delta variant, which has slowed the economy, and that's probably also caused the markets to pull back just a little bit and slow down some of the forward projected growth, but not enough to really kill the market. Okay. And of course, if we look across Europe, as you can see on the screen there, the Euro stocks was down, but the FTSE, the CAC 40, just slightly above, the DAX just slightly down. So everybody is around flatline in Europe. Still, year to date, everybody's higher. All right, everybody's doing very well. In fact, the CAC 40 is up 19.12%. Okay. So I think there's kind of a combination of optimism on strong corporate earnings, offset by the concerns of the spread of the Delta variant, which seems to be stronger in Europe than it is here in the US. And we did see the Eurozone economy bounce back from an official recession in Q2, growing by a faster than expected 2% relative to the first 3 months of this year for Europe. Okay, the year over year growth of Europe is 13.7%. That also topped estimates. Euro inflation also accelerated to 2.2% in July from 1.9% in June, lifted primarily by higher energy prices. But if you take food and fuel out, which they like to do here in the US too, it kind of makes inflation seem lower. But I mean, why wouldn't you include food and fuel? That's a big price that consumers have to pay. But if you do strip it out, the inflation rate then is at 90 basis points. But be that as it may, inflation is moving higher worldwide, is what we're seeing. Okay. And then, of course, if we look over the Asia Pacific area, everybody's in the red. Okay. Nikkei, China, Hang Seng, China, and Hang Seng, the Hong Kong index, down hard. Year to date, they're down. In fact, China has just had declared war on their technology sector. And they went back into an official bear market. I mean, it's just really tough. And they do not want to see the technology sector in China gain too much influence around the Chinese consumer. They're going to cut them right off at the knees. They're more concerned about that and losing control of the consumer than they are about economic growth right now. And that just shows you the power of what Xi is doing, right? So they're cutting the technology power over there. It started with canceling the Ant Financial IPO, and then the most recent one, DD, they chopped them off at the knees as well. Now, I think there's going to be a bounce in these things, but be very careful when it comes to Chinese stocks. Okay. They also kicked in, you kicked them in the butt about a regulatory overhaul for-profit education sector as well. So JD.com got crushed. Others got crushed as well. Technology, healthcare, property stocks, they all just spilled over. It just kind of rolled over. Okay. This is the worst weekly drop in China since February this year. And for the month of July, Chinese market shed about 7.9%. That was its biggest monthly drop since October 2018. Okay. So anyway, record high volumes, a lot of selling across China and Hang Seng, kind of rolled across to the Japanese markets as well. So not a very good week. I think there will be a little bit of a dead cat bounce in some of these. You could play a dead cat bounce kind of scenario. Be very careful in them if you jump into these. Okay. So that's kind of what we're looking at on the indexes. Now I'm going to switch the screens here and take you over to the charts just to show you what I see. Let me just move it over like this here. Let's go look at the daily, as we always do, of the E-mini S&P 500 futures market. Okay, let's go take a look at that, see how that's shaping. It'll take a couple of seconds to come up on the screen. So now that we got it on the screen here and looking at it, you can see that we're doing pretty good. I mean, we're near all-time highs. We made an all-time high this past week, and it's just sitting there right at this level. Now you can see we had a divergence fire off a bed. We call it a bearish divergence, and I suspect we're probably going to come down. I think the odds favor a testing of the 50 EMA again, which would put us down around 42.83, call it 4,300. We're at 43.95, so that's about almost 100 points from where we are now to the downside. That is nothing, guys. It really is a small move in my mind. And then how we react around that 50 EMA will be very telling. Every time we've touched the 50 EMA this year, and let me just take the chart back. I've shown you this before, but I'm going to show for those of you that haven't seen it. Again, every time we touch the 50 EMA, right? And it's happened 1, 2, 3, 4, 5 times. We've either closed at or slightly below it. The very next bar was a solid green because the algos kicked off and the buyer the dip crowd jumped back in. So if we come down and test it again, which we will, it's only a matter of time. We got the divergence firing off. So if we do come down and hit it, watch to see the buy the dip crowd will probably step back in again. But if it rolls back over, then the odds favor another 4 to 5% drop from there. Now, I have been calling through the end of August, essentially a pullback of anywhere from 7 to 12% with all this money floating in there. And if they get any semblance of a stimulus bill, even if it's that watered down one of 600-700 billion, that's going to keep the market supported, right? So if we do get a drop, it'll be a technical drop, and then it'll be a buy the dip. But if just showing you, taking it down to the 50 EMAs, 3%, an additional 4 to 5% there gives us 7 to 8%. So I would say this pivot point right here at 40.29 would be, to me, a reasonable assumption over the next 6 weeks that we work our way down there. Now, it'll be enough to scare the children because we have not had a drop like that since last September, okay, which was the biggest drop we've had outside of the COVID crash, right? It was only over 10%. It wasn't that much. Nasdaq will take it worse, okay? But that would be what I would expect. Now, the 200 EMA, now both of these, the 50 and the 200, have an upward trajectory to it. So by the time we get there, it'll be up a little bit, but that would give us an official correction if we come down and kiss the 200 EMA, roughly that point. And that puts us down around 2950 to somewhere between 2950 and 3000. And that's not a very far pullback. It's about 400 and some odd points, 440, 450 points from where we are right now. So that would be my expectation. If we get a 5 to 6% and we get another one of these scenarios, then you want to buy the dip, you want to follow in. If there's follow through, then it's clearly a buy the dip moment. If there's not follow through and we have a bull trap and it rolls back over and it takes out the previous low, then load up the shorts because it's going to run another 3 to 5%. So that is kind of a macro view. If we look at the FANG index, or at least the one that I've created here, which is a combination of Microsoft, Facebook, Apple, Netflix, Google, and Amazon, you can see how it gapped down on Friday. That was probably due to some of the bad report that came out Thursday evening from Amazon. But again, it can fall down to this shaded zone here, which is what I would expect. The breadth in the market still sucks. It is very poor breadth, meaning, and it's normal though, as the markets move higher and higher, it's usually supported by fewer and fewer stocks, primarily these mega cap growth stocks. But if they give it up, then we're going to see a fast move lower, right? And then you want to load up, have some cash available, because then when it starts to bottom, and then it starts rocking and rolling back up. Members, I'll give you guys a pretty good idea of when that's going to happen as we're going through it on when it's a good time to buy the dip, okay? But I think this next dip could be a sell the rally kind of mode, as the dip is going to be defined as being a lot deeper than just simply 1.5 or 2%, which is what we seem to be getting most of the year so far, okay? If we look at Nasdaq, the Nasdaq 100 futures, you can see here that it made an all-time high on the 26th, this past week. And it's still up here elevated, but we're getting these divergent signals on here. The 50 EMA is sitting at 14,445. So about 500 or 600 points south of there. Really not much of a move, but I could see it coming down between the 50 and the 200 very quickly, very easily, right? So we're just going to have to stay on top of it. The Russell, the last all-time high in the Russell futures was made way back over here on March 15th. It's just been porpoising. It's been staying in this wide shaded zone here. When it gets up towards the top, it's worth selling. When it gets down here around the bottom, it's worth buying, right? But we're still, you can see here, it cannot broach the 50 EMA, which is this red line right here. The 200 EMA kind of provides support down here, but if it breaks this, it's going to come down and test the 2020 closing price, which would pretty much wipe out all the gains of the Russell this year. I don't think we're going to get that bad of a pullback in March. I still believe it should be north of 5, so 7 to 10%. Could we get in correction territory? Possibly so. Okay, it just depends on the nature of the pullback and the speed and what's causing it, right? And there's enough things coming out in the month of August that could cause it to drop and give us that correction. So what I'm instructing all of our members on is be quick to take your profits off the table. Keep your position sizes about half the size right now, because the market seemed to be settling in for the month of August and September. Okay, so we need to just be very careful around these levels. Now, I'm going to show you the tracking stock for Asia. And this one is just, it really shows you just the damage that China did to their tech stocks. Look at this. You can see that gap down here. This was on the 27th. Now it gapped up a little bit, but we're still in the red for the year, okay? And just to measure the damage that was done from peak to trough, right down here like that, you can see it was about a 22% drop. So it was official bear market territory for a period of time. Now, if I bring it up to where it closed, we're at 18.9. Let's call it 19% below. Okay. So we're straddling on a bear market. We're still in official correction territory. And obviously right here is where it closed last year. So that is the dividing line between being in the green for the year and being in the red. And China, ever since this marker right over here in May, has been, cutting back, and they've been cutting stimulus. Now they're going to probably reverse course, realize they did too much too fast, and they're probably going to add some stimulus back into the market. So buying the dip here would make sense, but be very careful that it's not a bull trap. All right. And keep in mind that emerging markets is about 35% or so allocated to China. So if we look at emerging markets, EEM, you can see the high for the year right up at that level. Okay. And you can see that the low for this year was right down at that level right there. And just looking at emerging markets, if I did the same high to low treatment here, not quite in a bear territory. It was in correction, 14.5. And that's because emerging markets, about 35% of the weighting goes to China. So that caused most of the pain. The other stocks are okay. They're not great, but they're okay. All right. So you got to be careful when you pick up EEM, because traditionally a big portion of that is China. All right. So that's kind of what I'm looking at here on the major indexes. Now, Bitcoin, it had a strong finish to the week. Look at the week. I mean, it started down here around the 20th, around 29,000, and it finished the week at 40,000. Right, so it's about 11,000 point move in a very short period of time. Now, the question here is this a bull trap? If you look at the Elliott wave count, it would suggest it is. You got a 3-leg down, a 4-leg here, and then a 5-leg further down here. My system is indicating if you count the Elliott waves, assuming these numbers are correct, we're going to get an Elliott wave 5 that's going to broach the 29.7. My target had been around the 27 level, right down in this area here. The Elliott wave count was indicating around 21,000. So be very careful here. For our members, we are trading Bitcoin longer term to the upside, but it's a trade that allows us to hedge downside risk while playing the upside. Okay. So members, we'll probably talk about that a little bit this Sunday evening in our weekly market watch. So that's kind of where we are right now. If we come over and look at the bond market, let me just look at this right here. Where are we here? If we come over and we look at, not the bond market, let's look at volatility real quick. If we take a look at vol, you can see here, we're still in the choppy market zone, right? In this yellow zone. That's typically when the VIX is around 14.5 to about 50 or to 20. You're in a choppy market here. And we've been moving up as the markets have been moving up. And as our members know, that's a no-no for vol. When that happens, typically vol, we will see a spike as we did here, where it spiked up almost to 25, 26. Okay. We had the same issue here where it was moving up and the markets were moving up and it spiked up almost to 30. Right. So we got to, August could be an even more volatile month. So we got to be very careful. We got to watch and see what's going to happen with it. If we look at treasuries, we look at the bond market, interest rates, when bonds gets up here, the odds favor bonds coming down. Now, bonds finished Friday up, so it's going to have a hard time holding it up here because interest rates are fairly low. I think eventually bonds are going to roll back over, so perhaps trading a longer term position where bonds are going to go down makes sense. But if we do get that 5 to 10%, 7% pullback, in the month of August or September, bonds will move up a little bit higher, and I think you'll have a better entry for a short position in the bond market. Okay. If we look at the 10-year interest rate, it's going to reflect just the opposite because it moves opposite of bonds. You can see rates are just like have fallen off the table. We're down here. Now, my original projection for rates by the end of the year was up around 1.89%, 1.9. So I think playing this to the upside, you have a better odds of success, although there is no divergence here. That would suggest any move up is going to be met down. So that tells me that we're still not done moving lower in interest rates or higher in bonds. So we got to watch this very closely. Of course, if we look at gold, gold had an ugly day on Friday. It had a great day on Thursday, an ugly day on Friday, right? So again, to me, gold is in this consolidation phase. I think it's going to break out to the upside, but we just have to watch it and look at it very closely here, and just kind of see how this thing plays itself out, right? I could also, let me just redraw this just a little bit here. Let's see here, like this. See if I can do it like that. If I redraw it like this, let's get this on here like this. I'm going to get a trend line going on this thing here. Come down here like that. Get it like that. Then what that does is it just shows gold is building up here. So it would show somewhere out here in September, October timeframe, we're going to get a break in this. And the break is either going to be up or down. Typically, the normal break in this symmetrical triangle, you break in the direction that it kind of moved into the triangle, which means from the bottom up, right? So that would suggest that it's going to break to the upside and move up. So, and that kind of goes along with my thinking of longer term, gold is going to be higher. In fact, I had projected way up here earlier on, but gold, you know, when bonds and interest rates and inflation did a reversal, gold started getting into this longer consolidation phase. So we are also playing like Bitcoin. We're playing gold and silver to the upside, but it's going to be a long-term trade, guys. It's not going to reach a good point for us until probably sometime in 2022, right? And that would involve both gold and silver. The other metal that we are playing is copper. Copper is going to have a hard time hitting that level right there. You can see the trend line on copper. I could probably adjust it just a little bit and move it like this, right? And give me a natural trend line in copper, right? And then if we break this to the downside, I've got a support area right here, but copper is also called Dr. Copper, meaning when the global economy is strong, copper is strong. If we have a pretty good little hard pullback, you're going to see copper pull back a pretty good little bit, and then we're just going to have to watch it, okay? So this is a little bit about where we're sitting in the metals market. And then, of course, if we come over to oil, this one to me is an easier trade. You can, if we just, let me just zoom back in on this one. Oil trade right here. Just like I told our members here, we wanted to fade the move on this Elliott Wave 5, fade the move, and trade range bound in oil, okay? Anywhere from $80 a barrel down to $60 a barrel. Go out a couple of months. You can do call condors, put condors, iron condors, and you could trade this, I think, in a fairly easy fashion for about a 3-week period. Take your profits. You don't need to wait to get max profits, and then just, you know, continue to put them on and put them off. I think, at least right now, that's kind of what I'm seeing. Keep in mind, if the markets do fall hard, oil is going to go down with it. Natural gas, if we look at nat gas, it's just elevated up here. So there is a minor divergence sign on there. I think nat gas will come down and consolidate around this level here, make one final attempt higher. If we can get it higher, I'll be interested in going more all in on shorts to the downside with nat gas. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in and check us out. It's going to be a really interesting second half to this year. And then what's really going to be wild is 2022 going into 2023. There's going to be some huge opportunities for us. All right, everybody, have a great weekend. Members, I'll see you tomorrow evening at 8 p.m. Eastern Standard Time. See you guys. Ciao.